Hi, everybody. This is Ron Lang with MajesticTrader.com doing a webinar on high probability trading with sectors. And we have a lot to review with you over the next 45 minutes to an hour. We'll first start off with a little bit of background, who and what is MajesticTrader.com. We will talk about sector trading and looking for high probability trades, understanding the movement of sectors and how it works with market cycles. We'll do a market forecast, provide some trading ideas, and we'll also have a special guest, Michelle Hurlbut with Traders Breakthrough. And Michelle will be talking about preparing your mind for trading. And there's a lot of really good things that Michelle will go through. She's only going to have about 10 minutes with us, but we encourage you to go to her website, tradersbreakthrough.com. So first comes first, we'll do a quick advertisement, a little bit of background on MajesticTrader.com. A lot of people want to know a little bit more about who we are and what we do. Essentially, we're stock pickers. We don't have software. We don't necessarily we're not getting people together for a conference. We're not doing live seminars, at least not yet. Basically, we're stock pickers. We provide a weekly newsletter that gives you expert market commentary and provides you a trading plan with excellent trading ideas that are very close to entry. And it's up to you and your trading style to pick which of those trades you're going to do, and we'll provide you complete trade management. So as an example, one of the things that we'll do is we'll provide you a list of all the open positions. What was the entry? Did it hit first or second target? We want to recommend a stop loss to you, and we'll give you very key and specific notes to manage your trade. So once you're able to do that and manage your trade, you might want to look for new opportunities, and we'll give you both long and short opportunities. As a matter of fact, we might actually give you 2 entries for each of these. So as an example, if you're going to go long, we might tell you to go long once it hits a price on the upside or when it pulls back, and vice versa for a short. And depending on the market and where we see the market going, we might have more shorts than longs or more longs than shorts. Again, depending on what your trading style is, you can pick and choose which might work best for you. If you can't go short, but you can do options, certainly, every single trading idea in our newsletter, you can put options on, both long and short. I know I do a lot of options, both puts and calls, vertical spread, so on and so forth, and I take my ideas right out of our trading plan. We also give you expert commentary, so we want basically a look back and a look forward to what's going on in the markets, geopolitically, earnings, economic report schedule, so on and so forth. We also want to give you a list of the best picks of the week and maybe a few to keep your eye on for new entry or additional accumulation. We also provide you complete performance. Most importantly, profitability. We haven't had a losing month. There are people out there that only win 40% of the time, but they have incredible P&L because they practice very, very good risk management. So we have some winning months as far as winning trades over losing trades, but we have very, very profitable months because of the way we manage our trades, and we'll help you do that. We also give you a forecast for the S&P, where it was in the last week, what levels you need to be aware of in the upcoming weeks. And this is critical because based upon how you trade, you want to know whether or not you should go and or stay short or long. We also provide you stock analysis videos regarding the specific either midweek alerts or trading idea stocks that we put into the videos. We always give our members first dibs on watching those videos, and then 3 to 4 days later, we will then post them publicly. We have a midweek alert program, which we'll talk about in a minute. You can bring up any archived newsletters. Basically, we provide the last 4. If you want some from 3 or 4 or 10 months ago, we have all those archived and you can request them. We have complete trading performance. So we give you a list of every single trading idea. And what you'll be able to do is you'll be able to look and see every single trade that we've done, wins or losses, and the notes. and determine, what worked for you, what worked for us. I don't know too many other people that provide the level of information that we do in a newsletter format and gives you complete trade performance. We also give you a money back guarantee, which many people don't also. So if you have an annual subscription, we also offer that money back guarantee. So very quick example on a midweek alert. Basically, we send these out during the week. There are some weeks we might not send any out. There are some weeks we might send 2 or 3 or even 5 or 6. Last week we gave this one out, the CDE. This had a beautiful ABC pattern into a demand support area here, and we called an entry at on the cross of the 8 moving average, and we were looking for a target here of 2368 to 2507. As of October 11th, it was moving very nicely, and October 12th, it hit 2374. So it actually hit the target here on Wednesday, October 12th. And that was a real nice trade, and we know some of our members took advantage of that. In addition to WDC, Western Digital, we had an entry here of 2532. And one of our members did very well on this because what they did, they followed our trading plan. Because of the volatility of the market, they took half off the table at T1 and at target 1, and they let the rest run to target 2, which it did very, very nicely here on the following day. So these are the ideas that we provide throughout the week. If we find some really good opportunities during the week that hasn't made our trading plan yet on Sunday, but you might be able to take advantage of it on a Tuesday, Wednesday, or Thursday. If you go to our website too, we have a partnership section, and what you'll be able to do is you'll be able to determine which of these partners are a best fit for you. We have partnerships with people that provide you indicators for your trading platform. We have other partners that that will provide you trading psychology, which Michelle will talk about in a little bit. And we have others that that write trading books to help you better focus in on what might be a good trading strategy, build your trading plan, so on and so forth. So you want to check that out. So let's talk about sectors. One of the first things that you want to do is you want to talk about the movement of the Dow. So before we break down any sector, it's good to understand how the Dow works. And even though the Dow is made up of 30 stocks, the top 5 stocks make up 35% of the index movement. Now, the Dow is also, you can trade that in the DIA, which is the Dow ETF, or the E-mini YM, which is the Dow future. And based upon, how different stocks in here trade will obviously move the index. Alcoa just reported earnings on Tuesday, October 11th. Well, they missed by 7 cents, but because it only makes up 0.79% of the overall Dow, how much is that really going to move it? But if IBM missed by 7 cents, well, because it makes up better than 11% of the index movement, well, certainly that's going to affect it. Well, sectors work no differently than the way the Dow components work. So we're going to talk about that now. So as an example, we have different market cycles. And in different market cycles, the different sectors will perform better or worse. So as an example, you have stage 1, which is accumulation. Stage 2 is where you have a bull market and a lot of people jump on board. Stage 1 is where the institutions come in. Then you have, stage 1 is where the institutions come in. Late stage 2 is where retail comes in. Stage 3 is where you get topping into the market or basing, and stage 3 is the bear market or the fall in the market. So a lot of people are trying to determine where we are. I think we're about middle bear territory. A lot of people think that we're a late bear, which I really definitely do not believe at this point. A lot of people are pointing to we're going to dip down into another recession for 6 months in 2012. It already feels like it now, but early 2012 will probably be there. So if we're around 1,200 on the S&P right now, well, then the late bear puts us around the 1,000 or the 900 to 950 range down here or lower. And a lot of times if you look at it here in the early stages of the market, financials is one of the biggest sectors that a lot of people like to pile into, because the banks and the financials will be able to do very well in a bull market run. Even though it did okay, not great, in the last bull market run that we had from September 2010 to April 2011. But if you notice here, the precious metals, number 11, was up here. And if you notice, that's where we topped out the end of April, early May. That's where silver topped out. Gold didn't top out for a few months later to the August time frame. But those are some of the things that you need to be aware of. So we have this other chart here that I really like. I obviously swiped this. So good artists create, great artists steal. And this is a great representation of how the market works. Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. Well, what do we have in the markets right now? A lot of fear and a lot of uncertainty. This is where all the institutions are. This is where the institutions love to accumulate. A lot of people feel that right now we're in a sucker's rally. We had a really nice run here, 8 to 10% of the markets in the last week, week and a half. Are we here or are we here? My opinion, we're in the complacency stage, because if we're about to start a new recession, this is where we're going to be. Institutions come in here. Good traders typically come in here. Retail comes in here. All the people on Main Street feel as if, I'm too late for the market. Everybody's making money except for me. They put their money in right about here and lose it. So this happens in cycles, and it happens year after year, decade after decade, and obviously probably century after century. So this is a great chart to really identify the psychology of the individual that actually puts money into the market, from the institutional group to the traders to the retail sector. And if you really truly look at how this works, if you're an emotional person and you have money on the line, you have probably experienced every single emotion that's on the screen right now. So if we take a look at the sectors again, the one sector I'd like to focus in on is the energy sector, which I've traded quite a bit over the last year. So if you look here, typically the energy sector peaks at the top of the market, which it did in April and May. So I'm looking to see where it might be a good time to get back into a lot of the energy stocks. Now, one of the best ways I describe how sectors work is, since 70% of the stocks in the market all run together, they're all correlated, basically stocks are typically sheep and follow the herd. And if you've seen the Blue Angels, they all move together. So how do they all move together? Well, the price direction is typically in this order. Number 1, it's global condition. 2, it's the market conditions. 3 is the sector and the sector leaders. 4 is the specific business sector. And then 5 is the actual stock itself. Now, probably a year ago, maybe even 5 years ago, you might not have had global condition in there. But with everything that's been going on with Europe, with the tsunami in Japan, which we're still affected by the way, you have to look and see what's going on globally, because we are extremely headline driven, and we need to see where things stand before we jump into a stock and how long we might hold on to it for. So as an example, some of the secondary factors you need to think about. Look at the economic reports. Number 1, which is a great indicator of future economic health. Motor vehicle sales. This is both car and truck. Well, if you see sales going up, that's a good thing. If it stagnates, well, then there's a trickle effect in the auto industry, because now you have stocks like Ford, Toyota, General Motors, all of the dealerships they have around the country, all of the service that they offer around the country, and how about all of the part manufacturers that provide parts to the auto manufacturers. So it has a tremendous trickle effect. When we had a meltdown 3 years ago, and essentially GM went bankrupt, well, think about it. Delphi, which was one of the largest suppliers to GM, went bankrupt. There is a tremendous trickle effect. GDP, I don't think that needs much explanation. If you don't know what GDP is and how that affects the markets, you probably shouldn't be trading your money. But essentially, the GDP is probably the granddaddy economic report out of all of them, and one of our core four that we look at. And if you look at the GDP, economists will basically say if we have 2 negative quarters of GDP growth, that's a recession. If you ask 6 economists what's going to happen 6 months from now, what are you going to get? 6 different answers. So I don't really trust the economists to tell me when there's going to be a recession. Most people out there know when a recession is coming, and most people feel it 3 to 6 months before the GDP actually goes negative. Unemployment, granddaddy number 2 economic report. We're at 9.1%. Basically, as of October 13th, we were over 400,000 again for initial jobless claims. And we've been averaging over 100,000 for well over a year now. Probably 2, if I believe, is the correct fact there. And what they're telling you is, in order to get this down to even, I think, 7.5 to 8%, they have to get the initial jobless claims down to 200,000. So we've been averaging over 400,000 for the last 1 to 2 years, and we have to cut that in half just to get unemployment down by 2%, 1.5 to 2%. I mean, think about the effort that needs to be done there. Home price index. Well, we just had a housing crash 3 years ago, and it's probably going to take another 3 to 5 years to wind ourselves out of it. Many cities now, with the huge inventories they have in housing, they're actually leveling these houses to get rid of the inventory in these really bad neighborhoods because nobody's going to buy them anyway, so why even have them on the market? And the Case-Shiller Home Price Index, so when you want to look at this on an economic calendar, it looks as Case-Shiller HPI for Home Price Index. Essentially, the Home Price Index has now hit its 3rd bottom in the last 3 years. And people want to look because once home prices are on the rise again, well, then people might look and say, hey, things are looking up. For every new house that's built creates 3 new jobs. So if home prices are going up, perhaps there's going to be some expansion with home building, that'll create jobs. So there's a trickle effect in the home building industry too. Obviously, it's very commoditized with the materials they need and very labor intensive to build new houses and for home improvement. Earnings. This is a huge secondary factor. There was a situation last April during earnings season where IBM had fantastic earnings and they identified big growth in their cloud and storage business. I happen to be in EMC and SanDisk, SNDK. And in the aftermarket, both of those stocks were up big when IBM's numbers were released. Why? Because EMC and SNDK, SanDisk, are huge in the cloud and storage business. And if IBM is recognizing significant growth in their business, well, then it's only going to lift other stocks in the sector that are very similar to that. Obviously, and I don't need to tell you this, IBM is obviously a sector leader across different sectors, but mainly technology. But then they're across many different business sectors, from computer services to obviously cloud and storage and many others. Then you have a derivative trade within a sector. So as an example, in July, Apple released fantastic earnings, as they typically have done and will continue to do. Well, I identified there that Broadcom was actually a pretty cheap stock. And Broadcom and Qualcomm are 2 of the biggest suppliers to Apple. I went in and I bought Broadcom ahead of Broadcom's earnings, which sometimes isn't the wisest thing to do, but I also protected my risk with some options. Broadcom jumped about 4.5 points between when Apple released their earnings and when Broadcom released their earnings, and I got out of the trade with a very nice profit. Again, that's a derivatives trade. So these are some of the other things you want to do. Apple obviously is the leader, and then you want to look at their suppliers to see who else can be riding the coattails of this good news. So these are some of the things that you need to be aware of to make you a better trader and look for profitable trades. So These are the top 10 sectors. These are the spiders year to date in performance. The top 3 identified here, the utilities, consumer staples, and healthcare, are the only ones in positive territory. But when you look at this in year to date, you can see the financials and the home builders are lagging. And that shouldn't surprise anybody. So obviously home builders like Lennar, Toll Brothers, Hovnanian, these are all stocks that, if you look at their charts, they look very ugly and very broken. The financials, they just keep getting bad news. Everything from Bank of America to JP Morgan that had good earnings, but they were propped up by other things. I mean, you got to really look into the details of the financials. Right now, one of the biggest things is how exposed are our banks to Greece and other European nations. And Morgan Stanley and JP Morgan are affected. But right now, nobody will release how much exposure they have. So, with all this uncertainty, look for these sectors to be beaten down maybe another 10 to 15% more, especially if we are in the early bear market. The home builders and the financials are going to be affected before most of these other ones. So you might see another 20 to 25% downside there. So we have the XLE, which is the energy. So let's look at that. So when you're looking at the XLE, you might be thinking, well, what stocks make up the energy sector? Well, you have oil and gas operations, you have oil well services and equipment, oil and gas, the integrated companies, and you also have coal. But when you want to look at the XLE, which is a very popular sector ETF that's being traded out there, you want to know, well, what are the top stocks? Well, it just so happens that the top 7 stocks make up 54% of the total holdings of XLE. You have XOM, you have ExxonMobil, that makes up 17%. So if you really look at this, almost 20% of the entire move is XLE. So if ExxonMobil is going to report earnings, you want to know, you want to know, well, how exposed are you to the XLE if you're trading it? Or if ExxonMobil is going to report and you're trading CVX, which is Chevron, how long are you? How exposed are you? You have SLB, Schlumberger, you have COP, ConocoPhillips, Occidental Petroleum and Halliburton, and then Apache. So you have these top 7 that make this up. If you want to trade XLE, you have to know how these 7 stocks are performing. So if you look at the chart, you see that this is a significant downtrend here. But we recently broke this downtrend, and the leaders, those top 7 stocks, are pushing its way through the downtrend, obviously to try and get to this supply resistance area up here. So one of the things that you want to be able to do is to say, well, what other popular stocks that are energy stocks have a good chance at riding the coattails of XLE? Well, WMB, Williams Companies, which is a stock that I've traded quite a bit, is a $15.5 billion market cap stock. This is not a slouch of a company in the energy sector. So what you need to do is you need to look at the chart. Chart looks very similar to the XLE, but what don't you see that's happened yet? It hasn't broken downtrend. So if it breaks the downtrend and the XLE continues its way up, WMB is an excellent, excellent trade for you to consider riding the coattails. One of the biggest things that you want to see when it breaks downtrend, you want to see if the volume, if there's better than average volume and a lot of up volume that makes up that total volume, then this is a great trade to go into. At least a half position until it proves itself above that downtrend, and then you could put the balance of your position on if XLE is going to continue to lead its way higher.